Well, good afternoon, everybody. I can say that because it's 12 o'clock Eastern Standard Time. I guess some of you are probably in the morning, so good morning to you. My name is Tracy, and I am the Director of Gift Planning at Skidmore College. And I want to welcome you to our webinar today. And let me just make sure my screen is set properly. All righty. So I'm going to talk to you about achieving your philanthropic goals, how to maximize your impact for Skidmore College. As I said, I'm the Director of Gift Planning here, and I've really had a great privilege, and it's an honor for me to work with people. Everybody's different. Everybody has different goals. For example, recently, this year, I've had the privilege of working with a couple of people on their estate gifts. One particular donor wanted to make a gift through their estate to honor their mother. And they want to be anonymous. Their mother was a teacher, so important in her life. And so it was just been wonderful to help her achieve something that's very important to her. We've done that. We actually just recently wrapped that up in a way that's going to be very meaningful. I worked with another person this year who actually wanted to do another estate gift. And their motivation was they wanted to pay back a scholarship. They wouldn't have been able to attend Skidmore were it not for a scholarship. And so this particular person did well in life and really wants to pay it back to the college. So very rewarding. I recently just worked with somebody who, although they're not subject to federal estate taxes, they were subject to their individual estate, and they wanted to reduce the size of their estate to so that it wasn't taxed. And so they chose to do a charitable gift annuity. It's a gift that pays income back to the donor. So those are just a few examples of people that I've worked with this year. I've been doing this for 28 years, and it's, as I said, it's very rewarding. So I want to share with you some ideas that maybe you haven't considered as you go about thinking about how you want to make an impact at Skidmore. So with that introduction, I will talk about three different categories of gifts. Current gifts that you make right now, gifts that pay income, I mentioned that just a minute ago, and estate gifts. And actually, before I go into this, I just noticed that we have what people hope to take away from this presentation. Just a few things here. People wanted to make informed choices. They wanted tax ideas. I'm going to definitely cover that. Strategies to drive gift giving to Skidmore. Sounds like maybe somebody from one of the reunion classes there. Certainly, I'll have some things for that. Somebody wants to learn about bequests, and I will definitely talk about that. The new tax law, and I'm definitely going to talk about that. So those are some of the things that people wanted to learn about. So as I said, current gifts, gifts that produce income, life income gifts, and estate gifts. Regarding current gifts, and this is something that can actually drive class giving. For the new tax law, there's a universal charitable deduction for non-itemizers. Years ago, when the standard deduction went up, many people stopped itemizing on their income tax returns. But this year, single filers can deduct up to $1,000 in charitable gifts. So a person as a single filer can give $1,000 to Skidmore, and they can actually reduce their taxable income by that $1,000. Joint filers, married couples, can deduct up to $2,000. How does that reduce the cost of your gift? Well, the example for a single filer, if a person gives $1,000 to the Skidmore Fund, for example, and they're in the 22% federal income tax bracket, that gift will save them actually $220 in taxes because they're in the 22% tax bracket. So the gift actually costs not $1,000 but $780. So this is a way that you can tell people that, hey, support the college and it's not going to cost you as much as what your gift costs. And so that's new in the tax law this year, and it's something that people may not be aware of, and I want to make sure that you are aware of it. So For current gifts, long-term, highly appreciated securities. A lot of times when people make gifts, they don't think of appreciated stocks or appreciated mutual funds and that sort of thing. They simply will write a check out of their checkbook, and those are wonderful gifts, and we love them. But it's really, there's a lot of advantages to donating long-term, highly appreciated securities. And first, I say highly appreciated, you know what that means, but long-term means that you've owned it for more than 12 months. And chances are, if it's highly appreciated, you'll definitely have owned it for more than 12 months. Why are these good gifts? Because frankly, it costs you less than giving cash. The reason why is that you paid less for that particular security, and it's gone up in value, but your cost, the money that you paid for it, was a lot less. So it costs you less. For people that itemize, there's a charitable deduction for the full fair market value of whatever that security is. And that can be significant, obviously. Plus, any security that's highly appreciated is a potential tax liability. It's your capital gain in that particular security. And when you donate the stock or mutual fund to the college, you will actually eliminate that capital gain from your portfolio, which is helpful, certainly. And some people will say, well, I like that stock. Well, great. Use the cash that you would have otherwise donated to Skidmore. Use that cash to repurchase that particular stock at a higher basis. So you still own it, and you've eliminated your capital gain from that stock or mutual fund. So let's give you an example what that looks like. Let's compare a $2,500 cash gift with a $2,500 stock gift. A $2,500 gift will make you a President's Society member, and we're grateful for all our President's Society members that may be watching this. Thank you. So if you give cash, your gift costs $2,500. Let's assume that you itemize your income taxes and you're in the 32% income tax bracket. So 32% of $2,500 is $800. So you save $800 on your taxes. So the net cost of your cash gift is $1,700. So not bad. However, let's say you own some Meta stock, that Facebook that you bought years ago for $1,000, and it's currently worth $2,500. Well, you're going to get the same tax savings because you're in the 32% tax bracket. The value of that stock is now $2,500, so you're going to save $800. But since you paid only $1,000, you save $800 in your taxes. The real net cost of your gift is only $200. So $200 versus $1,700. The choice is obvious. The stock gift is far more advantageous for you to give. There's also some other benefits, which I alluded to before, is that you eliminate a $1,500 capital gain from your portfolio. Where's that gain? Well, you paid $1,000. The stock's worth $2,500. It's gone up in $1,500 in value. That's a potential tax liability, is capital gain. So you don't have that anymore in your in your portfolio. You avoid $220 for that particular gain. You avoid $225 in capital gain tax, which is you would be taxed at 15% times the $1,500. That's where that number comes from. And as I mentioned before, let's say you love that stock. You just use your $2,500 that you would have donated, use that to repurchase it at a higher basis. So it's really well, good from every standpoint that you can possibly think of. There's really no downside to doing that. All right, so that's cash giving versus appreciated stock. And as I said, it has to be long-term, and it could be stock, it could be mutual funds as well. I say stock, any kind of appreciated security works for that. And we have instructions, we can help you with that. Let's go on to IRA giving, otherwise known as a Qualified Charitable Distribution, or QCD. These are direct transfers from your IRA to Skidmore College. You do not take a distribution from your IRA and then write out a separate check to Skidmore. If you do that, you have increased your income, and which is one of the advantages of the QCD is you don't increase your income. What you have to do is you have to have your administrator of your IRA make a payment directly to Skidmore College. And sometimes different companies issue checkbooks, which are very convenient. And so if you can write a check directly out of your IRA payable to Skidmore, that's also a QCD, a Qualified Charitable Distribution. And I say IRA because some people think of a 401k, for example, as the same thing. It's not. A QCD must be made from an IRA, an individual retirement account. Is it possible to roll money from a 401k or other tax advantaged accounts, pre-tax accounts, into an IRA? Absolutely. And people definitely do that. And then they can take advantage of this QCD option here. You have to be at least 70 and a half years old to do a qualified charitable distribution out of your IRA. And it does not, when you make this kind of gift, it does not increase your taxable income. So the next bullet on there, possible savings on Medicare premiums. Medicare Part B premiums are based on income. And so sometimes when people take distributions from their IRAs or their retirement accounts, it increases their income to a higher threshold for the Medicare premiums. So a QCD will actually avoid the increase in income, and potentially it could lower your Medicare Part B premium cost. You'd have to look at the individual numbers on all that, but that is definitely a possibility and an advantage of doing a QCD. If you're 73 and a half and older, you know that you have to take what's called a required minimum distribution. And if you do a QCD, you get credit for that required minimum distribution. But the big thing is it does not increase your taxable income. So it's really a great way to give. And right now it's indexed for inflation every year. But right now, during 2025, you can give up to $115,000 per person, per IRA owner, is the annual maximum that you can give. And as long as Skidmore is certainly a qualified charity, but you can give that to any qualified charity, and your gifts can add up to $115,000, have not increased your income, and you get RMD credit. As I said, it's a great way to give. All right, so what are some other current gifts? And you notice I'm not talking about cash too much, but like I said, we love cash gifts, but these are different gifts that have tax advantages to them. If you have any questions, by the way, you can submit them in the button below. Feel free to do that, and I'll be happy to get to those. I'm going to read some questions at the end, but if you have questions now, I'm happy to answer them. So just feel free to submit them. Other categories of current gifts: real estate. Real estate is a very flexible gift. I've worked with a number of people here at the college on real estate gifts. They can be given outright. A lot of times it's like a vacation property that, hey, the kids don't come home anymore. The grandkids, the kids and the grandkids, they go elsewhere. And so the property is frankly more trouble than what it's worth, and people have donated homes like that, and as an outright gift. They can also be used to fund a life income gift. I'll get to that in just a minute. But there's another gift which is called a retained life estate, and that is actually a gift of real estate. A retained life estate is a gift of your home to the college, but you retain the right to live in that home for the rest of your life. And you save a lot of money on income taxes for up to 6 years. This is a gift that's very, for somebody who's giving a large punt, maybe their entire estate to the college. and they know they're going to stay in that home. The advantage of this is that you get a very large income tax deduction at the time that the gift is made, and you can take up to 6 years to take that on your taxes. Your gift actually, your home actually has what's two portions to it. One is the life use portion, and you retain that. And the other portion is the remainder interest. A retained life estate gift, and we've done those, are great ways for people to get a tax advantage for an estate gift, but to get it in their lifetime. And as I said, the income tax deduction is very significant on the home. Happy to run illustrations for anybody. We can figure exactly how much you could save on that, but it is very significant. Certainly way more than half of the value of the current market value of the home. So if it was worth $500,000, your income tax deduction would be much greater than $250,000. Could be $300,000-$400,000 easily. So those are great gifts. We take gifts of artwork. For the Tang Museum has just celebrated its 25th anniversary, and the Tang is a teaching museum, and we do accept gifts of artwork. There's a process for that, and we evaluate the artwork to see if it will fit in with our educational mission, and if it does, we're happy to accept it. And so let me know about that. We take gifts of horses, and I never knew that horses were so expensive, but we do take those, and we're happy to work with you on that as well. There's a process that we go through for accepting gifts of horses. We accept gifts of life insurance policies that have cash value. So those are just an idea of some other current gifts that you can give. So that's current gifts. Let's move on to our second category of gifts, which are life income gifts. How do they work? What's a life income gift? Well, you donate cash, appreciated securities, or even real estate to the college, and you earn a partial income tax deduction. Well, why is it partial? Why isn't it the whole value of what you donate? Well, the reason why it's partial is because you're going to receive an income back. And so there's a way that the IRS has us calculate your income tax deduction, and it's based on how much money we're going to pay you and essentially your age. And so the older you are, the larger your income tax deduction will be. You will receive payments for life, and those payments are very secure, and you don't have to worry about not receiving them. You will receive them. And then whatever is left over your gift is designated for your charitable purpose. And as I mentioned, I think at the beginning, I worked with somebody who wanted to reduce their taxable estate. They love baseball, and we have a new baseball field under construction, and they want the remainder of their gift to go towards the fund that will help maintain that in the future. So whatever it is, if you want it to go to scholarship, we have plenty of people that actually have the remainder of their gifts, life income gift, go towards scholarships. That's probably our most popular designation is scholarship. And so there's two payment options for you. One is a fixed payment where you receive the same amount. That's called a charitable gift annuity. The amount of the payment does not vary from year to year. You know exactly what it's going to be. It's going to be the same amount every year. And then the second option is a variable payment option, and that would come from a charitable remainder unit trust. So let me talk about those for a moment. For fixed income payments, that's charitable gift annuity. The age, the income payment is based on your age. Skidmore follows this rates set by the American Council on Gift Annuities, and 95% of charities in the United States actually follow these rates. And here's some sample rates. They're based on age, and as you can see, they increase with age. And 5.7% for a 65-year-old, 9.1% for an 85-year-old. And let's say if a gift is $10,000, a 65-year-old would receive $570 per year for life. A person who's 85, if they gave $10,000, would receive $910 per year for life. So it's based on age. One thing that some people aren't aware of is that the payments don't always have to start at the time that you make the gift. Sometimes people want the income to start in the future, and that's certainly possible. And let's say you want it to start in the future, but you're not even sure when in the future you might want your payments to start. You can do that. That's a flexible gift annuity. So you can start now, you can start at a specified date in the future, like in 2 years, for example, or you can reserve the right to start it when you're ready. And we have a number of donors who've done just that, and who we have a small, easily read contract that actually specifies exactly what you'll get at each of those years in the future. And then you decide when you want to start. The minimum gift for a charitable gift annuity is $10,000, and you have to be at least 60 years old. Do we accept gifts from people that are in their 50s for a charitable gift annuity? Yes, we do. However, payments cannot start until the age of 60. And the last thing I wanted to mention is that it is possible to use IRA money to fund a charitable gift annuity. However, and you can use up to $54,000 next year on that, and you can only do it in 1 year. So that $54,000, you can't do like $24,000 this year and the remaining $30,000 next year. The way the law is written is that once you use the benefit that year, it's over. So a lot of people like to max out, as I said, it's $54,000. And so those are charitable gift annuities, fixed payments, very reliable. They're guaranteed by Skidmore's endowment. And so you can count on the payments for sure. Variable payment life income gifts, also known as a charitable remainder unit trust. A charitable remainder unit trust, you will receive a percent of the trust as revalued annually. A lot of times people will set up a 5% charitable remainder unit trust. And if you put $100,000 in that, you're going to receive 5% next year, which would be $5,000. And then let's say at the end of next year, your 100,000 has grown to $110,000. So you would receive the following year 5% of the $110,000, or $5,500. So if the value of the trust goes up, your 5% that year would be more money. Conversely, if the value of the trust goes down, and we all know that investments do go down, especially here lately, we've seen a little bit of that, then your payment would be less that next year. These trusts are valued typically on January 1st every year. And so the payments are set for the year based on the January 1st value in the trust. We do suggest holding down the payment to 5%. A lot of times, in the past, I've worked with donors that had a very high payout rate, and they insisted on having it. And you can do that. However, if your payout rate is like 10% or something, and I've actually had people do that, there is an excellent chance that trust will, essentially the payments will dwindle down to nothing. And the reason why we say hold it to 5% is that if the investment return, the average annual investment return exceeds that payout rate of 5%, then the value of your payments will grow in time. And that is very doable over time to exceed 5% average annual investments return. Whereas if you set the payout rate very high, you really don't have much of a chance of increasing your payments. In fact, your payments are going to shrink and eventually not be hardly anything. So anyway, the trust is invested for long-term growth. We take your stock or your real estate. We sell the real estate, for example. If you put real estate in there, we sell that real estate. There's no capital gain tax, and then we reinvest everything, stock, real estate, what have you. And it's invested for long-term growth. So an equity portion for sure in there. We can talk about whether the mix is high in equities and low on fixed income, but the goal would be actually to serve as an inflation hedge for you. And there's no capital gain for highly appreciated stock and real estate, as I said, that's sold inside the trust. So those are variable payments, a lot of flexibility in a charitable remainder unit trust. Skidmore uses BNY to administer both our charitable gift annuity program as well as charitable remainder unit trusts. All right, so that's life income gifts. Let's talk about estate gifts. And before I get into any detail, I wanted to mention the importance of sharing designations with us. If you have a designation for your gift and we cannot do that, we won't take the gift. It's a rare thing that happens, but it has happened. I've seen it, and unfortunately, we're legally obligated to use your gift as you direct. So if you have a designation, please check with us. We want to make sure we can do what it is that you want us to do. As I said, the most popular designation is scholarship. Skidmore does a terrific job in providing financial aid. We are committed to meeting 100% of the financial need of our students, and we've been doing that thanks to our donors. So those are great gifts. And as I said, a lot of these estate gifts go towards scholarships. If you don't want to designate your estate gift, and that's great, we are fine with that. If your gift is under $150,000, it will go toward the Skidmore Fund and support current operations. Much of the Skidmore Fund is used to provide scholarship support to our students. So that's essentially what's going to happen. If you give a gift and you don't leave us a designation, it'll be used for the Skidmore Fund if it's under 150. If it's $150,000 or greater, then the College Board of Trustees will decide how to use your gift. And those gifts are either put into the endowment for long-term operation and health of the college, or they're actually used for capital construction. That's generally how those larger gifts are used. So talk to us. If you're not sure, maybe you are thinking about designating your estate gift, but you're not sure, I'm happy to discuss different options with you. It's something, you want it to be meaningful. And we know how important estate gifts are to our donors because, I have children. Some of you may have children. What do you do with your stuff? You give it to your children. So when people leave estate gifts to the college, it's like the college is being adopted into the family. It's very special. And we want to make sure that we can honor your legacy in a way that's meaningful to you. So please contact me. So how can you do this? Sometimes it involves a lawyer, and that's the first one. A will or living trust. Beneficiary designations don't involve lawyers, but let's talk about the first one, a will or a living trust. A living trust is simply a way to avoid the probate process. When you see your attorney, you can decide what's best, a will or a living trust. And people can give a set dollar amount to the college, and they can put in their will, I want this to go to scholarships, or they can put a percentage. And I always think percentages are good because if the value of your estate fluctuates, which it does, it'll automatically adjust the size of your gift. Some people make specific gifts to family members, and then they leave whatever's left over in their estate to the college as well. It's called a residual gift. And those are wonderful gifts as well. So you'll definitely need to see an attorney for a gift through your will or your living trust. We have suggested legal language, which I'm happy to provide. And I've done that with people who are working with their attorneys, and they appreciate that language. And we do a little tweaking back and forth, and it comes out exactly the way it should be. So we're happy to provide that language. We have that available. It is not necessary always, as I said, to visit a lawyer and pay legal fees. You can actually do a beneficiary designation from the comfort of your home on your computer. And you can designate retirement accounts, commercial annuities, bank or brokerage accounts, and even life insurance policies. There is a definite tax advantage to making Skidmore a beneficiary of your retirement account. If you have a choice, you have heirs and you want to leave them a retirement account or something that has already been taxed, you want to leave them something that's already been taxed. Because if you leave them a retirement account, they are going to receive that and it's going to be diminished by taxes. Whereas if you have, for example, a brokerage account, and you make them a beneficiary of some stock, for example, they'll get a step up in the cost basis and they'll get a tax advantage there. But the retirement account, if you leave that to heirs, there's going to be certainly income taxes involved and potentially estate tax, either federal, which is a pretty high number these days, the value where taxes kick in. But states actually have much lower, a lot of states have lower thresholds for estate tax. And your retirement account can be diminished by that. So given a choice, retirement accounts make great gifts for charities, and we do accept those, and there's an advantage. Same goes for a commercial annuity, the same benefits there, and the same taxes if you give it to heirs. If you have a bank or a brokerage account, you can get a designation form as you can for retirement accounts and annuities and your life insurance policy. And you just write in Skidmore College. We have our tax ID. It's available on our website. You can contact me, but you'll need that, our Skidmore's federal tax ID. It's an easy way to make a gift, and you can do it, as I said, from the comfort of your home. Doesn't cost you anything. And another way is through a donor-advised fund successor. People are using donor-advised funds at Fidelity, for example, or Vanguard. They make gifts to their donor-advised fund, and they get an income tax deduction when they make that gift. And then it's invested, and then you can tell Fidelity, for example, hey, I want you to give $2,500 to Skidmore this year. And they cut a check to Skidmore, and we receive your donation from your donor-advised fund. However, you can also make Skidmore a beneficiary, a remainder beneficiary after your lifetime of your donor-advised fund. And so that's another way to make a gift essentially through your estate. So those are the different ways to make estate gifts. And I think we might be, yes, I'm not going to thank you yet. Well, let's see here. So we do have some questions, actually. And let me go to those. Hang on. So the first question I have here is, I'm donating much of my estate to Skidmore. Do I get any tax advantages? Well, so first of all, thank you. It's wonderful that you're doing that. And as far as tax advantages, certainly if you're subject to estate tax, you will reduce the amount of your estate tax by making that gift through your estate to the college. However, as I just wanted to refresh my comments, or remind you of the comments I made earlier about a retained life estate gift. If you are giving much of your estate to the college and you have enough assets, frankly, to take care of long-term health care, for example, you could do a retained life estate where you deed the remainder of your home to the college, but you retain life use, and you get a very significant income tax deduction. You maintain the home, you continue to live there. Everything is the same. The only thing that is different is that you get that income tax deduction, and your home, frankly, is removed from your estate when you do that. So whoever settles your estate does not have to do that. Worry about disposing of your home. You have actually given it to the college, the remainder interest. So that is a big way to get a tax advantage from your estate now, and you save real tax dollars up to 6 years. So there's limits as to what you can deduct every year, but you do have up to a total of 6 years. Looks like we have another question here. I have stock that has gone way up in value, but I don't want to donate it because I really like this company. Any suggestions? Well, yes, absolutely. So you can donate it to the college and then use whatever money you had that you were thinking about giving. Presumably you've given to Skidmore every year, but you thought maybe stock's better. But yeah, stock is better. Just use your cash to repurchase the security after you donate it to the college. And so you've eliminated that capital gain from your portfolio. Presumably, you said it's gone way up in value. Presumably, you've owned it for more than 12 months. That's important. It has to be long-term. So that is a way that you can really incur some tax benefits. You get the full fair market value for your deduction if you itemize, and you get that tax advantage of removing the capital gain. So that is it for the questions I see for right now, although I had some pre-submitted questions when people registered, and let me find those. Okay, let me see here. Oh, okay. So there is another question that actually just came in. Is there a way that I can make a gift to Skidmore from my estate without incurring the expense of an attorney? And I get it. People don't go see your attorney on a whim. I mean, you wait for major life changes to visit an attorney. You know, there's a birth of a grandchild, or you move, or you retire. So you visit attorneys when you need to see them. And so you want to know, can you do something without seeing an attorney? Absolutely. As I mentioned, beneficiary designations on retirement accounts, on commercial annuities, on bank accounts, on brokerage accounts, on life insurance policies. Those are all, you don't need to use an attorney to do those. Your estate planning attorney probably wants to know, I'm sure, about the total value of your assets. But when you get to that stage, you can just tell them, look, I've made Skidmore beneficiary of my brokerage account, and they'll certainly won't have a problem with that. So that is a way that you can do that. As I said, let me see, is there any more? Okay, there's another one here. I like the idea of making a gift that pays income back to me, but I don't want to receive this income until I retire. Okay, sure. Or maybe even sometime after I retire. Is this possible? Absolutely. You can designate, if you know when you're going to retire. Let's say you're going to retire at age 70, you can do the gift with us, charitable gift annuity, and specify in the little contract that we have that payments would start when you reach the age of 70. If you're not sure, you can do, as I mentioned, it's called a flexible gift annuity, which lays out what your payment would be at age 70, 71, 72, 3, 4, 5, whatever you want to do. We can lay out exactly what the payment would be if it starts at each of those ages. And then you can decide in the future. You make your gift now, but you decide in the future when you would start it. And the advantage of doing that is, of course, you would get that income tax deduction right now when you make your gift, and then you can start the income stream to you in the future. We've done plenty of gifts like that, exactly like that. So let me see. I think that's it there. Now, pre-submitted here, somebody made a comment about gifts of real estate or complicated assets to receive. If that's an intention to make a real estate gift, how best would a donor set a plan that is best for the college? Gifts of real estate are wonderful and very significant, I think, for obvious reasons. There is a process where Skidmore actually does due diligence. We don't want to put Skidmore's endowment at risk. So frankly, it's usually just a routine process, but we evaluate risk associated with the property. There's a process, takes 4 to 6 weeks, maybe something like that, before we can formally accept your gift. So that is, you want to know how it's best to set a plan for the college. Talk to us, whether you're going to leave that through your estate or not. Typically, if somebody leaves us real estate through their estate, what I like to do is I like the estate to liquidate the property, sell it, and then donate the proceeds to the college. And that insulates Skidmore's endowment for any potential liabilities. Don't want to get real legalistic, but it's really important that we protect this endowment of the college. If you do that in your lifetime, certainly we'll work very closely with you on that and make that as smooth as possible. I'm not sure if that answers the question, but you also have another question here. Restricted gifts can be complicated for the college, but if that matters to a donor, what is the healthiest way to go about it? So yes, we get a lot of restricted gifts. And as I mentioned, it's very important to talk to us about your restriction. We want to make sure we can honor that restriction. So the healthiest way to go about it is to talk to us. And if there's an issue, we'll tell you. 95% of the time, there's not an issue. But and we can talk to you about other things maybe you haven't thought about. So that hopefully answers your questions. And I don't know that we have anything else. If you're in reunion, and I think a number of you are, you should have received a brochure about non-cash giving. And it actually covers a lot of these concepts in that brochure. You'll find my contact information in that brochure, and feel free to contact me at any time. I can run gift illustrations for you for life income gifts. For example, we can plug in your age and so forth. We can talk about designations, and just really happy. As I said, it's my privilege to help people accomplish something that's meaningful for them. So I thank you for your interest. And as you can see here on this page, there's my email address, there's my telephone number, and then the gift planning website is myimpact.skidmore.edu. I think you'll find a lot of good information there. Feel free to reach out in whatever way works best for you. So I thank you, and hope you enjoy the rest of your day. Okay, take care. Bye-bye.